So we know that Donald Trump wants to do more and more trade within the United States. So he wants to lower energy costs as well within the US. So that means people don't have to spend as much to live. Also, it means production costs are cheaper for businesses. That makes America even more efficient. And he really doesn't want to spend money overseas either. He doesn't want to spend it on US aid. He doesn't want to spend it importing goods. And he doesn't want to spend it on defense either. So keeping as much money as possible in the United States. Now, we know he's going to achieve all of those things because he's already done most of it in the first month. So what does that do, Steve, for America? All this money, the same population, if they are all wealthier, if they are all producing more, well, actually, if they're producing more, I was going to say, surely all of this extra money means that that prices are going to go up. But then if they are producing more and it's the same population, well, I guess there's going to be an oversupply of goods. So you could argue, actually, that prices go down. How does that play out? What does this, his master plan for supremacy, actually, what does that mean for example, the price of stuff in the United States, if it's all made within the United States?
Well, I mean, there are two elements to this. He's trying to drag as much economic activity back from overseas to locally, and that obviously is going to, if that worked, you'd be putting more expenditure by Americans to be going to buying American goods. So that's an increase in the money supply circulating in America. But at the same time, he wants to slash the deficit, and this is where I've seen Musk talking about the maths is terrifying, rising interest payments, yada, yada, yada. That's a common belief. It's promoted by conventional economists. I've seen Jeffrey Sachs make the same argument, and it's completely wrong because that deficit is partly how you create money. And, we'll explain more in the rest of the podcast. But what he's doing is simultaneously saying, let's keep more money in America, while he's also, without knowing it, saying, let's create less money in America. You put the two together, I've got a feeling it's going to be the destruction of money or the lack of creation of money that rules. And having had a few personal communications from people who have been on the receiving end of a termination email from not from Donald Trump directly, but from Doge and so on. Yeah. People are terrified, and the people because something like, I'm not sure what proportion of the workforce is with the federal government, but about 30% of America's GDP comes from the government. And if you're making one third of the people terrified about their future employability, they're not going to be spending more money. They're going to be spending more slowly. So I think the combination of the two.
Right, but you could say that's a transitionary period. So say, for example, and we haven't got time in this episode, but we will revisit it or go back to previous episodes when we looked at how the idea that reducing a government's deficit actually reduces the money supply.
Yeah.
And most people don't agree with that. But
people don't agree with gravity either. I'd like to see them defy it.
There's too many people disagree with the idea of gravity. But let's assume though. Say for example that they realise that mistake and they say, okay, well, let's up government spending. Made a mistake there. You've still got, even more so, you've got all this money concentrated in America. And that's what I want to look at today.
Okay.
If they're spending, you made the point that if they're spending less overseas, I mean, that's adding to the money supply, of course, because the money supply gets reduced if you've got money leaving the country. It's a bit more complicated when it's a reserve currency as well, of course. But if it's all being kept within America, but you've got the same number of people, but you've also producing more, and perhaps you're getting more efficient at producing stuff as well, does that push prices up or does it bring prices down? What does it do to the American economy before we start looking at the rest of the world?
I mean, well, okay, that's a pretty big hypothetical. But if you start from saying they're going to, continue the deficit, so they continue government money creation as well as the private sector creating money. Banks create money by lending more than they take back in repayments. The government creates money by spending more than it takes back in taxation. If those are still happening, and then you're trying to restrict consumption to American goods, so you're reducing the amount of imports, and they're also trying to boost exports at the same time. This is classic mercantilism in that sense. Then he's going to have a increasing turnover of money in America, And the general effect of this is where conventional economics, as usual, is a perfect guide to what's going to happen. Whatever a textbook tells you, expect the opposite. So the conventional expectation for economists, well, that's going to drive up cost because you're going to have a high level of demand inside the economy. That high level of demand is going to mean that the cost of production rises because all production is subject to diminishing marginal productivity. That's the economist jargon for saying that as you add more workers, who is a variable input, to the same amount of machinery, which is a fixed input, then you get less output per worker, even if each worker individually is productive as any other. Therefore, prices are going to rise. Now, that is a great guide. Therefore, expect the opposite, because when research has been done into the cost structure of firms, without fail, I think there's about 70 research surveys that have been done, they all found that firms have constant or falling what are called marginal costs as they increase output. So you actually reduce the pressure on prices. And one of the most remarkable papers reaching that conclusion statistically, not by doing a survey, was by two guys called Kittleton and Prescott. Now, you have a hard time finding more reactionary right-wing economists than those guys. They were responsible for the modern, what's called real business cycle theory, which gave way to the modern, what they call dynamic stochastic general equilibrium models. And they did a very well-designed statistical survey using what's called a Hodrick filter, Prescott-Hodrick filter, I think it is.
Oh, yes.
Okay, you know that one well, of course. Yeah, what that does, it separates, it tries to take the actual ups and downs of all economic variables and then find the trend through that, sort of a curve-fitting exercise. And then you look at the deviations from trend and then correlate those deviations from trend with each other. And what they found was that rising economic activity causes falling inflation. Now, that's going to sound...
But that is intuitive, isn't it? I mean,
no, it's not.
Well, I would have thought if you produce something and you set up factories which are producing more of it, you get economies of scale, and that enables you to reduce the unit cost per item that you sell. That's intuitive, isn't it?
You've sort of, but you've got the economies of scale. The people confuse these things all the time, including economists. But economies of scale relate to increasing the scale of your operation. You go from a factory that turns out 250,000 units to one that turns out a million units. And then with the bigger scale, you get the economies of scale come from having bigger.
Well, but that's so you produce, and you would only do that if you knew it was going to be. You wouldn't upscale unless you knew that you either could take a bigger margin or sell more at a lower price.
Yeah,
and,
but that's
increase
still
your EBIT.
Yeah, but that still involves investment, building new machinery, building new factories and so on. It actually applies if you don't change the scale of the factories at all. And this is where conventional economics is completely misleading, armchair garbage about how firms actually operate.
Because their argument, we're going down a rabbit hole. Or if people are watching us on YouTube for the first time, we do go down rabbit holes. My job is to pull us.
He's trying to pull me back up again.
But let's go down this rabbit hole.
He's trying to pull me out of the rabbit hole.
Let's go down the rabbit hole for a second, though. So, I mean, the argument would be, not thinking of it as an economist, it would be a capacity question, wouldn't it? So if you've got a factory that produces 1,000 of something and you're selling 990 and you know there's demand for another 50, you're going to push your price up.
If you're in that situation where you're absolutely capacity, you will. But the real world, and this is why conventional economics is so completely misleading, they have this idea that you are all producing, you have a whole bunch of factories all producing homogeneous goods. So, for example, you and I buy a car, okay? And what's the equilibrium price for a car? Any idea? It's a stupid question, isn't it? Because you can pay 10,000 for what used to be a Prada and $1 million for a Bugatti. There's no such thing as a homogeneous car. So there's a whole range of different factories, each producing their own specific vehicles. And when you look at how those factories are designed, they're designed by engineers, thank God, not by economists. And what the engineers do is first of all, then they've got to build for scale. So they expect to have growth over over time. So when the factory opens, it has to be operating well within capacity. You've got to have, if you build a factory which was 100% engaged on day one, you made factories too small. So if you expect growth over time, you're at least going to say that even if you've got an established product and you're expanding your capacity to produce it by creating a new factory, you're going to start working at no more than 70% capacity. So in other words, you're going to have 30% of your machinery which is idle. And it's idle for a good reason. Two reasons. One, you expect a growing economy. You want to build the factory for that growth. And secondly, you've got a different product to your rivals. Your product might, it's a differentiation from the core concept of a car, may give you great advantage. You want to be able to expand without needing to do any additional investment. So, and if your competitors stuff up, you want to have room to sell into the mistakes that they make. So this is the real world. And in that real world, when engineers design a factory, they first of all make sure that the product can be made for a maximum cost per unit in terms of the variable costs, the materials that go into it, the labour, the stuff you have to buy from suppliers and so on. So they work out that cost and say, okay, that's our base cost. Put a markup on that, and the markup reflects what their competitors do, whether they think their product is better or worse than the that sort of jazz.
All that sort of
so there's a gap between the variable cost per unit and the list price. There's no such thing as a downward sloping demand curve for Bugattis or even Pradas. Yeah? There's this constant. If you want to pay it, this is the price you pay. The price includes a markup. Each element sold makes a profit. So in that world, you design your factory, and the factory gives you your fixed costs. You've got to look at what's your cost of maintaining the factory per year, paying so you get a declining cost per unit as you increase the volume of output. So most firms face constant unit cost variable cost per unit, falling fixed costs. They work at about, say, 80%, 90% capacity if they're an established player, and they've got that spare capacity there. So if economic demand rises, per unit cost falls. And that's what turned up in this Kittlin and Prescott
because
survey.
It's all fixed, because so much of it's fixed cost.
Yeah,
and actually
that's right.
The price that they're charging, which isn't an economics principle, it's a marketing principle. The price they charge is what they can actually get away with. It's how much the perceived value of that product is, which, as you said, is a million and one different variables. Okay, let's pull ourselves back out of that.
Oh damn! I enjoy being done holes anyway.
Because the question is there a ceiling to supremacy in the United States?
Yeah.
And we started talking about money supply. And I'm wondering whether that actually ultimately is the ceiling, because we know growth is a combination of how much money there is in circulation and how quickly that money changes hand, the velocity of money. Now, the biggest variable is probably actually the amount of money that's in circulation. I mean, the velocity does move rapidly, but generally as a trend around the world, it's slowed down because, as we've talked about a lot on this podcast, so much of it ends up in the financial sector, and we'll talk about that as well, because that's an important part of all of this. But is the ceiling on growth going to be in the United States, even though all of this is, they've got the hope that all of these companies are coming back, they're going to be very efficient, they're not going to spend as much overseas, but are they going to reach a point where growth is just going to slow down to a trickle because there is no extra money in circulation unless they create more government money?
What tends to happen, I mean, what's more likely to happen is that they are going to continue with the slashing of government spending, and that's going to completely derail the hypothetical we're dealing with right now.
But if they didn't?
If they didn't, well, the real question is, what does America not produce that is critical for American industry to have? And the only, there's two elements to that. One is that they don't make the semiconductors. They make some, but most of the semiconductors are made in Taiwan. They don't make the machinery to make semiconductors.
They've just signed this big deal, though, $200 billion or whatever it is. They've just signed this big deal with Taiwan Semiconductors. They're going to make semiconductors in America. So, I mean, they're working on that one.
It'll take a while. I mean, those factories are the most complicated machines on the planet. So to get and you need the staff to be able to manage them as well. I mean, as well as reading this technically, one of my old schoolmates actually ended up being the chief chip designer for Motorola. So I've got some internal knowledge of just. But
they're working on that. You'd assume. I mean, if that is the plan, if that's the strategy, and it takes 4, 5, 10 years or whatever, that's what they're trying to do. They're trying to bring everything everything into America,
Yeah,
so
well,
that
that's
America is self-sufficient. I'm just wondering what stops that from growing. So we, till we get to a situation, we'll have to take a break in a second, but we get to a situation where America is making so much money and the rest of the world is making so little. What does that mean for America, and what does it mean for the rest of the world? I mean, America can't surely have a standard of living and wealth which is so out of kilter with the rest of the world. It's got to be, the balance has got to be, there's some sort of limit to how much they can grow, and the exchange rate obviously is going to be part and parcel of all of this as well. What's the ceiling? Where does the ceiling cut in?
Well, I think the ceiling, I mean, what's not just the ceiling, you're moving the roof. Whenever you're doing investing, you're changing the height of the roof, okay? You're changing the constraints. And what America's been doing for the last 40 years, fundamentally, is shifting production offshore. A huge part of why America has the Rust Belt and why so many American what used to be blue-collar workers are now gig economy workers and feeling massively insecure. It's because American capitalists took advantage of incredibly cheap wages in China, in particular, to relocate production over there, and that stripped America of the skill base it used to have. So the main bottleneck, I think, is going to be the education system, because they're not training the engineers. They haven't got the apprenticeships. They don't have the structure in place to train people to work with this advanced technology, whereas that's absolutely gung-ho in China. So I think their main problem is going to be the education system. Right. And if the fact that people pay fees in America, which discourage you actually attempting to take a employment position in the first place. Why, when you go to university and acquire huge amounts of debt, why not work as a checkout chick at the local supermarket? Frankly, you might get lower income, but you have lower debt as well. So there's so many elements to the American system that are impediments to them building the skill base they need for this future they're trying to construct.
Well, look, Donald Trump is a smart man. I read that somewhere. Where did I?
Yeah, I think it may have been in his autobiography.
Oh, yeah, that was it. That's exactly where I read it. Yeah. So he realizes that, so he invests in education. This is a man who's doing everything. Oh, my God. Because I'm looking at everything he could possibly do.
There aren't mushrooms growing in your garden, are there? I'm getting worried here.
It's, I'm getting it from Mexico and Canada.
You've got so many hypotheticals, Anyway.
But he does all of this, right? And he gets, so much more happening within America, an educated workforce doing everything they need. So they've got almost like a closed system. The only way they're going to protect that, presumably, because if America has, if Americans have money from all of this efficiency, there's this danger, of course, they're going to spend it overseas. So he's going to need to keep tariffs. There's going to need to be some sort of differential pricing. And America can't, in an open global economy, can't have this exceptionalism where everyone is very wealthy without some sort of inhibitor to stop the rest of the world mucking things up for them, presumably. So tariffs would have to be part of his modus operandi, wouldn't they?
Well, they are anyway. We know that. So, yeah.
And he'll just have to keep on doing that. This isn't like a step in the process.
Well, it depends on how you do it. I mean, if you look at the countries that have successfully used industrial policy to grow their economies over time, they've almost all used tariffs. There's going down the rabbit hole again. There's a Harvard University professor, which obviously means mainstream, and normally I attack mainstream as being full of nonsense. But that's Danny Roderick, Rodrik, and he's done very good empirical analysis of what have been the successful industrialization strategies for countries around the world. And he found that what they do, they protect the domestic industry first of all, but then they put them under pressure to compete with foreign, with overseas. So you put a tariff up to mean you can no longer afford to buy an American car, but you say, okay, let's make a Japanese car instead. But it's got to be cheap and cheerful when you start, but make sure over time it becomes the same quality as the American. And we're going to reduce those tariffs after we've got the industrialization started. So that's the usual way that people industrialize. Now, if you just whack them up and do what Australia did, for example, which is say, bring your foreign producers onshore. Let's have 5 car companies, each of which is producing making 1/5 the scale of a factory in the rest of the world, 50,000 cars rather than 250,000. And let's see what happens where you get bloody expensive cars when the profits go overseas, et cetera, et cetera. So if you want to keep people keeping take those magic mushrooms, one of them has to be that they is bringing in the tariffs. They then deliberately reduce them to keep the competitive pressure on American manufacturers.
Okay, we're going to take a quick break. When we come back, I want to look at how do we
after you harvest some more mushrooms.
Yeah, I'm just going to make myself a little omelette. When we come back, I don't know if you've ever had one of those. Only once in my life, and never again. I have to tell you, when I was in Thailand once. There's a story for another day.
Same for me.
But when we come back, just what does it mean to the rest of the world, though, if we have a very dominant and increasingly dominant United States, and it's happening in double quick time, isn't it? So we'll look at that when we come back on the Debunking Economics podcast. Welcome back. We are looking at whether or not there is a ceiling to the supremacy of the United States, because obviously Donald Trump wants to be the supreme leader of the supreme nation. I mean, obviously the American economy is the most dominant economy in the world. And, you know, there's been talk for a long time that maybe that is starting to wane. Donald Trump is obviously trying to kick in a reversal to all of that. So is he going to be successful? Well, all the signs are, you know, if there's enough protectionism, Steve, if he's bringing into industry in, if he does educate the workforce, okay, there's a big if. But if, I mean, there's a chance that he's at least going to stop the slowdown in the US economy, and we are going to see some real growth, and it will stay as the number one economy for a long time. And in fact, if we look at, you know, the share market, look at the Magnificent Seven, for example. Let me give you some numbers. The market cap of the Magnificent Seven, 16 trillion US dollars. That's 3 times the GDP of Germany, 4 times the GDP of India and the UK. Not far off, actually, the GDP of China. 7 companies. It's more than half the GDP of the United States. I mean, what happens if, you know, the US generally, not just the Magnificent Seven, but the US generally continues to dominate in such a fashion? They're getting all the money. The rest of the world is struggling to keep up.
Well, this
that's not sustainable, surely.
Well, the main trick here, and this is where Yanis Varoufakis' work is quite useful. In the book you call The Global Minotaur, this is I think before he became Greek finance minister. So what he talked about was because we have an American dollar as the international unit of exchange, countries, you know, like Germany, from Germany to China to Australia, et cetera, when they want to buy goods or buy anything from the rest of the world, they need to convert their domestic currencies into American dollars. Now, that, first of all, means there's an excess demand for American dollars over and above what's necessary to buy American goods. So you get an overvalued exchange rate, and that makes it harder for American manufacturers to compete. But it also means to be able to enable the rest of the world to trade in American dollars, there have to be American dollars in which to trade. So a necessary outcome of being the reserve currency is you own a trade deficit. Now, that's the thing which Trump is trying to crush by all these measures. Now, if he succeeds, and I presume he had another mushroom in the break, so we'll continue down this fantasy path. If he succeeds, then there's going to be a decline in availability of American dollars for trade, which is going to bid up the American dollar. So that is going to effectively make it's going to be counterproductive. He's
fighting against it anyway, isn't he? The whole idea of tariffs in the first place was we're getting all of these cheap imports because of that. Because the reserve currency as being a large part of that, the value of the US dollar. So he's introducing tariffs to try and combat the strength of the US dollar. So actually,
But in fact, that's if it means it's harder and harder to get the American dollar is going to rise in price on international exchange rates. That at least is one place. You know, if you look at finance markets where the extra demand does mean you're going to get a rising price out of it. So yes, that's one. But
so talk about why would it be harder to get the American dollar though? Because they're spending
because they're going to be running a trade surplus.
No, right.
Okay. His objective is to have a trade surplus, okay? And not just, he's I mean, in this sense, mercantilism was the strategy that existed before we got the classical economists. So if you go back in time, you look at people like Thomas Munn, who was a merchant who wrote England's Wealth by Foreign Trade. And the whole idea was to sell as much as you can and import as little and accumulate gold, okay? And like that's exactly what, I'm sure Donald needs a couple more gold toilets scattered around his various possessions. I think the White House obviously needs a gold toilet. So like accumulate the gold and put it to use like that, or maybe put it back in Fort Knox. That's where he wants to get more gold.
Well, it's going to be
Knox.
The gold house, clearly, isn't it? Bit by
It's
bit, it'll be a show. Imagine
Yeah.
the show of American wealth if the White House is entirely made out of gold.
It's going to be a gold house, not a White House.
Exactly. I'm just worried about suggesting that now, because that's the sort of thing that goes viral. Donald picks it up and goes, "That's a good idea." And,
I know. The world is crazy enough. I mean, have another mushroom and think it over.
Let's go step by step through this then. So America starts to accumulate more of the world's wealth. I mean, can America grow and the rest at the rate it is, and the rest of the world keep up? Or is there? It's not a zero-sum game. Obviously, currency exchange rates are a zero-sum game, and that obviously plays into it. But America could grow, and the rest of the world could benefit from that, perhaps.
Well, I mean, I wouldn't worry. Let's stick with America. This is difficult enough to.
But what I'm concerned about is the imbalance. Is America? So we've already seen, for example, America. I mean, because of the spending.
Imbalances are the name of the game globally. I mean, there's a huge imbalance between America and Sudan, not in terms of gun warfare, but certainly in terms of income. So, it's imbalances are the rule. And like one of the main reasons that Keynes wanted to bring in an international exchange unit he called the Bancor was to avoid this sort of thing happening, to minimize imbalances. Now, Trump is classic mercantilist. He wants to maximize those imbalances for the benefit of America and accumulate as much as possible. But you can't do that and be the reserve currency at the same time. That's what I see as the trap, because if you do that, if you are the reserve currency and you're whacking up tariffs to make it harder for people to export to you, you're trying to sell more of your stuff globally, particularly oil, drill baby drill, you're going to have a trade surplus, and you're going to therefore drive up the value of the American dollar, which is going to make those new factories you're building less competitive, because the price of buying them is going to rise. Not for Americans themselves. They might find the price level falling in America or not growing as rapidly if you do have that level of industrialization and expansion of productive capacity. But the stuff that you want to sell to the rest of the world is going to get more expensive. You're not going to see the trap is going to be he'd have to give up being the reserve currency. Now,
that might not be a problem.
That ain't going to happen. Okay.
Well, but it might not be a problem for him. I mean, he might go, well, actually, for the reasons you've just outlined, what is there in it for us being the reserve currency of the world? And in
that's
fact,
what I would like him to do. Okay, that would be a great logical leap.
And you know what?
Maybe I just call it a leap, illogical.
But actually, the decision might be made for him for the wrong reasons. In that the rest of the world, Europe, for example, might say, well, how can we hurt America, given it's hurting us? And we'll all start buying stuff in euros. We'll buy oil in euros. Anything, because we're trading less with America these days. Less reason to use the US dollar. So let's trade in another one.
Well, he's trying to prevent that. I mean, he wants everything to be American. Including Canada, Denmark, and Greenland, and Mexico. Okay.
Exactly, most of the world. But from what you're saying, it sounds like if Europe, I mean, he may not want that now. Maybe he'll come to realize it. But if people stop trading in the US dollar, what you're saying is that would actually be very good for him, and it would allow this. He could develop a surplus.
Well, the only way that I can see him accepting that it'd be a good thing to have the American dollar cease being the international exchange unit would be if he could be persuaded that, in fact, that's a bit like the American being the military force for the rest of the world. You're carrying all the labor. We're using American troops and American weapons. You guys about, but you do a bit of spending. Exactly the same thing applies to the dollar. We've got our currency is carrying the burden of international trade. You guys help carry the burden of international trade. That might be the way to turn him off on that. The one obsession which is going to undermine all this, which is American dollar is the strongest on the planet. That undermines your manufacturing sector. Makes it harder to do what you're trying to achieve domestically. If you want to really boost domestic industry, you should arrange, bring in the Bancor. Okay? Take over the mantle that Keynes wanted to have as the person who finally made international trade sensible, and campaign to have the Bancor. You can call it the Domcor. Okay, that'd be fine. Call it the Trump. Okay, we want to have a new international current unit called the Trump. Everybody starts with 0 Trumps, and if you're on a trade surplus, you accumulate Trumps. That's it. You're then in a casino, so you might actually like the fact that he's getting more gambling chips. So something we need to bring in the Trump for international trade. Okay, that'd be the way that he manages to get out of that particular trap of driving up the value of the dollar and undermining his manufacturing ambitions back at home.
I think you're onto a winner there.
There you go. We've renamed the bank called the Trump. Let's see how that works.
And that's exactly. He doesn't need to worry about the detail, obviously. so it'll suit him right down to the ground. So okay, just one final point then. So America is getting wealthier. There's more stuff coming online. There's more money being produced in the economy. People only need so much stuff. So they are going to. So some stuff is going to be exported. They're going to produce for exports because they will obviously saturate the domestic demand. But there's still that money there sitting in the economy. That's people have got to put that somewhere. They're obviously going to invest it, aren't they? So you're going to add to this strength that the US stock market and other forms of investments are dominating the world in. So that is an unhealthy imbalance as well. If all investment is driven to the United States, because that's the only area in the world now where we see growth in investments.
Well, I mean, the intriguing thing is that I've been a critic of the euro since its inception, a critic of it attempts to control government's deficits and ignore the trade deficit. But one side effect of Trump, the nationalism Trump is bringing to the table, is that the rest of the world's reacting the same way. So now Europe, despite having tied itself in knots over the euro, is now talking about establishing a separate fund. I saw Dirk Entz talking about this a couple of days ago, $500 billion investment fund they're going to create independent of the limitations of the Maastricht Treaty. So what this might mean is
the Eurobonds idea.
Yeah. We may find ourselves getting a focus on investment rather than specialization. And that's what actually gives you growth. The whole conventional economic nonsense about efficiently allocating resources. I might actually, just for people who don't read I'm going down the rabbit hole again, by the way, mate, watch out, get ready to grab my tail. Okay. Now, people will say that, the economists have taught you it's important to specialize, to do what you're best at, comparative advantage, et cetera, et cetera. And the definition of economics, which everybody cites, is to say that economics is the science of the allocation of scarce resources to unlimited wants. Now, if you go back and look at what the bloke actually wrote, that actually did write, which is Lionel Robbins back in the Great Depression, he said the allocation of scarce resources which have alternative uses.
Right.
Who wants? Now, okay, I would like to know the alternative use for a blast furnace. All the alternatives for a chip manufacturer. Could I use it to make a lasagna instead? The essential flaw in economic theory is to ignore how specialized products, industrialized products are. They're made for a specific purpose. You cannot reallocate them somewhere else. That's why
you can't have lasagna and chips.
You can't make lasagna with chips. Yeah, okay. Lasagna and chips is two pieces of carbohydrate. Very bad.
Very bad.
Your computer will work very slowly
if you've picked up nothing else in the last half hour, that's one thing you can take out. Yeah, I watched these two old guys talking about economics, and in the end, the conclusion was you can't have lasagna with chips because it's bad for your cholesterol.
Okay, yeah, but that's the flaw. So the whole neoclassical emphasis upon specialization is a complete furphy. That's not how the world operates. So by Donald Trump coming in here and mangling everything domestically and internationally, one outcome of that, he wants to go for national development and investment, and that's therefore meaning the rest of the world responds the same way. The conventional economists that actually might help. Okay, that's about the focus upon investment rather than the chimera of specialization may be a positive benefit.
Right, but the economist's answer to that, the economist's answer to that would be that resource argument. That's all fine, but that's all limited by the amount of resources that are available.
Well, if only they took resources seriously, which they don't. They took it in a mythical way rather than talking about the actual physical resources we need to produce goods and services, and the fact we're running out of, we're running out of cheap energy. So that's I wouldn't bother what economists have to say in reply.
Just as well, because we're out of time. There we are. This is the first time we've done this on video. We'll see how it goes. So if you're listening to us, well, on your website, Steve, we'll probably stick the video there. If you're listening on, or both versions, if you're listening on Acast or you're listening to the podcast on whatever your podcast platform is, this is also on YouTube. And if you're watching on YouTube, there's a whole load of previous podcasts available. Just look for the Debunking Economics podcast on your favorite podcast platform.
And hit that like and hit that subscribe.
And all that. You got it all. Yeah, there we are. We're like old pros at this now, aren't we? After one episode.
Yeah.
Good to talk, Steve. Catch you next time. Next week.
Okay, mate. Bye-bye.